Right now, Bitfarms Ltd is trading on the Toronto Stock Exchange at 6.24 Canadian dollars, and it is absolutely surging, up 11.43% on the day. That's a massive move, a gain of 64 cents on heavy volume. And this is the exact kind of moment where the dividing line between expectation and reality becomes incredibly sharp. The immediate expectation for many investors, especially those checking their accounts on Robinhood or SoFi Invest, is that a Bitcoin miner like Bitfarms simply follows the price of Bitcoin. If Bitcoin is flat or down, the miners should be too. And interestingly, if you look at the NASDAQ-listed version of this same company, ticker BITF, it's actually down today, trading around $3.93 USD, a drop of over 3%. This isn't just a small difference, it's a massive divergence. Two different markets, two different countries looking at the same company and coming to completely opposite conclusions in real time. This is the story. The reality is that the Canadian market is pricing in a fundamental shift in the company's narrative, something far more significant than the daily tick of a cryptocurrency. The common belief about Bitfarms and its peers has always been straightforward. It's a proxy for Bitcoin. It's a leveraged bet on the underlying digital asset. You buy it when you expect Bitcoin to rise, you sell it when you expect it to fall. You'd manage it in your Fidelity brokerage account, right alongside your Fidelity ETFs or Fidelity mutual funds as your high-risk, high-growth satellite holding. The entire investment thesis, for many, begins and ends there. But today's action, this dramatic split between the TSX and the NASDAQ, challenges that entire premise. The reality is that Bitfarms is aggressively trying to tell the market it is not just a Bitcoin miner anymore. And it appears at least one market is starting to listen, while the other is still stuck on the old script. The market is processing a new identity for the company, and the tension between those two narratives is what's creating this volatility. Let's look at the recent trading activity because it tells the real story. This surge on the TSX is not a random blip. It's built on a foundation of significant news. The company has been signaling a major strategic pivot. We just learned of their expansion plans at the Panther Creek campus, which is not about mining more Bitcoin. It's about building out a high-performance computing, or HPC, and artificial intelligence data center. This is a direct attempt to enter the same business that has turned Nvidia stock from a graphics card company into one of the largest corporations in the world. Bitfarms is sitting on significant power infrastructure, and the expectation is now shifting from how much Bitcoin can they mine to how much of that power can they sell to the power-hungry AI industry at a premium margin. This is a fundamental repricing. The company is trying to add a second, potentially more stable and higher margin business line. This isn't just a minor update, it's an attempt to change the entire bull case for the stock. And big players are noticing. This isn't just a retail-driven move. We saw recent filings that Thames Capital Management, a significant institutional player, has picked up around 7 million shares. When an institution of that size builds a position, they aren't using the simple Robinhood app. They're executing complex orders through platforms like Interactive Brokers, and their decision is based on deep analysis. They aren't buying because they think Bitcoin is going to pop next week. They are making a multi-quarter or multi-year bet that this pivot to AI and HPC is real and will create substantial value. This is the kind of investment help and validation that can change a stock's trajectory. It provides a floor and a new set of expectations. This institutional buy-in is a massive dose of reality, countering the old expectation of Bitfarms being just a small-cap crypto proxy. Furthermore, the company just secured its war chest to fund this transformation. They recently completed an upsized $588 million convertible senior notes offering. This move bolstered their total liquidity to over $1 billion. This is not a company struggling for cash. This is a company that has just armed itself with an enormous amount of capital to go on the offensive and build out this new AI infrastructure. The market sees that capital and understands the plan is not just a press release, it's a fully funded business strategy. So, while one investor, perhaps doing some self-investing on a simple platform, sees a Bitcoin miner and sells it in line with a dropping crypto price, the more sophisticated online investing crowd, looking at the filings and the strategy, sees a high-growth infrastructure play. It's a complete disconnect. The volume we're seeing today on the TSX, with millions of shares changing hands, reflects this new dynamic repricing. Traders are being forced to ask themselves what this company is worth. Is it a miner with a PE ratio tied to a volatile asset, or is it an infrastructure company that deserves a multiple closer to a data center or even a high-growth tech stock like Apple stock or Tesla stock in their early high-growth phases? That is the battle playing out right now on the tape. And as this new narrative gains traction, it's forcing a reevaluation from analysts at major investing sites and wealth management divisions, from Fidelity Wealth Management to private offices who now have to model a completely new revenue stream. Now, let's establish the baseline. What does Bitfarms actually do, or rather, what did it used to do? At its core, Bitfarms is a vertically integrated Bitcoin mining company. It was founded in 2017 and is based in Toronto, which is why its TSX listing is so significant. They build, own, and operate data centers that house specialized computers or miners that validate transactions on the Bitcoin blockchain. In return for this computational work, they are rewarded with new Bitcoin. Their whole business model was about maximizing their hash rate, their total computational power, while minimizing their cost, primarily the cost of electricity. They have operations in Canada, the United States, and Paraguay. But this model has risks, as we just saw with their announcement to exit Argentina due to power supply disruptions. That exit, while saving them from liabilities, also reduces their total hash rate, which under the old narrative would be a purely negative event. But under the new narrative, it's seen as trimming a low-margin, high-risk operation to focus capital on the high-margin, high-growth AI opportunity in the US and Canada. This is expectation versus reality in its purest form. This brings us to the future outlook, and this is where the tension is highest. The bullish scenario is that Bitfarms successfully executes this pivot. They use their billion-dollar liquidity to rapidly build out their HPC data centers. They leverage their expertise in energy procurement and data center operations to sign long-term, high-margin contracts with AI companies desperate for computing power. In this reality, the Bitcoin mining operation becomes a stable, cash-flowing base business, while the AI HPC segment becomes the explosive growth engine. The stock decouples from Bitcoin and starts trading on its AI growth prospects, attracting a whole new class of institutional investors who would never touch a crypto stock. This is the reality that today's 11% surge on the TSX is beginning to price in. Investors are looking at their Schwab Intelligent Portfolios or Fidelity IRAs and considering if this stock now fits a different, more diversified growth allocation. They might be setting up a new individual brokerage account just to trade this specific thesis. But there is a very real and very significant bearish reality. This new field is not empty. Bitfarms is not just competing with other miners, it's stepping into a ring with established giants. Competitors like Marathon Digital and Riot Platforms are also pivoting to AI and HPC, and they are, in some cases, even better capitalized. The risk is that Bitfarms, despite its billion-dollar chest, gets outspent and outmaneuvered. They could build all this new capacity only to find they can't secure the long-term, high-margin contracts they were expecting, forcing them to compete on price in a race to the bottom. There is tremendous execution risk. Running an AI data center is not the same as running a Bitcoin mine. The technical requirements, the client demands, and the security protocols are far more complex. There's also regulatory risk. As they build out this infrastructure, they'll face a new set of zoning, power, and environmental regulations. If they stumble in this execution, the market will be ruthless. The new narrative will collapse and the stock will revert to being just a Bitcoin proxy, but one that just spent $1 billion on a failed experiment. All that optimism we see on the TSX today could evaporate, and the stock could crash back down to realign with its NASDAQ-listed counterpart. So, as an investor, you're being forced to make a call.